We're all trying to make some sense of this. You're watching the markets under pressure this morning. And as Becky said, you could ascribe so very many reasons for that. That could be the COVID outbreak that we're seeing both here in the United States and abroad. It could be oil prices, which, of course, are correlated to that to some degree. It could be the elections. Right. What do you think and what do you do about it right now?
Well, I think the same factors are still driving, as we talked about last time I was on your show, and that is in the short term, the market's going to pay attention to where we are with stimulus, where we are with the election, and where we are with the vaccine and therapeutics. And so as we look at these earnings coming up this week and throughout the third quarter, what will be more important than the actual number is the guidance. And we saw that this morning with SAP. And so it brought the market down because it suggested that businesses were putting off spending a year or two from where they thought they would spend and the amounts they thought they would spend. And so the earnings reports will be particularly important insofar as they give us a view into what 2021 looks. Obviously, the fourth quarter will be important, but we'll soon be past these catalysts, these potentially negative catalysts that we've been talking about, and we'll start to focus on 2021 earnings and what we can get in terms of information or insight from these earnings reports will be critically important.
You've said there is no lasting tailwind to this recovery. What do you mean by that?
So what I specifically said is we should look for companies that don't have a structural lasting tailwind. When I go to parse my portfolio or when I go to parse my clients' portfolios, what I'm looking for into 2021 is those that gained a structural advantage versus those that will return to a baseline of 2019 or maybe even lower. And so lots of companies were positioned to succeed in the work-from-home environment, but was that lasting? That's the question we have to ask ourselves. And do they deserve the multiple that they're currently trading at? And so there's no shortage of companies that when we return to a new normal won't be able to put up the results that they put up this year, while others, like the e-retailers, experienced a structural shift, a structural tailwind that will allow them to put up 100% plus earnings growth over the next couple of years. And that's what we're looking for to support outsize.
Tell me how you're going to decipher the difference. Tell me how you're going to decipher the difference, because some people would argue that the e-retailers, I don't know if they would go back to where they were in 2019, but that if the world were to go to any kind of post-pandemic hopeful sense of normalcy, people might go back to brick and mortar shops occasionally. And the same might be said of a Zoom or some of the big tech companies that have had a lot of success during this period. Sure, their success has been accelerated during this period, but what happens afterwards?
Right, and I think you're right. This is the task. There are some that are easier than others to pinpoint and say, well, we might not be spending as much as paint when we're not stuck at home, or we might not be spending as much on flooring. So there are certain easy ones to decipher, and then there are harder ones. When you talk about the e-retailers, they were growing their penetration at 1% per year. In December of 2019, we saw that penetration at 19%. Now it's close to 30%. And just 7 months later, with something that had been growing at only 1% per year. So you're probably right. Not all of that may be lasting, but what we have to do as investors and prognosticators is pick out things that we don't think will revert to an as-is form before we saw the structural change.
Shepard Smith here. Thanks for watching CNBC on YouTube.